September. Positioning is substantially lower. A lot of the fast money community, hedge funds and so forth, have not really been embracing and participating in this rally. When you look at, prime, data from different prime brokerages, even JPM data, percentile-wise, we're in the bottom 20th percent since the beginning of 2018. So I would say, positioning-wise, this pain trade can continue to the upside. And the other thing is, we did have a big pivot in the Fed and policy, which is turning a lot more accommodative. And we are continuing to see progress on the trade side.
You think or at least it seems like you thought the inverted yield curve was much ado about nothing, that it wasn't sending the kind of signals that some were suggesting it was. Is that right?
Correct. I mean, there's two things I would like to point out. We published on this in quite depth. After the first instance of inversion, historically, the market tends to do just fine. And then secondly, when you look at the robustness of this inversion, it was quite weak.
Liz, is this Goldilocks?
So I think the tricky part about this is that depending on what your thesis is, no matter if you think we're going to continue in a bull market or roll over, you can find the data to support it. And that's tricky for investors. And some of the stuff that you can say on the positive side, this is actually really interesting. So the 65-day price move in the S&P 500 is now in the 99th percentile. Historically, since 1950, the forward 6 to 12 months has been well above average. So that would tell us that the rest of the year is actually going to be great. But then you look at some of the data, everything's slowing. The second quarter is looking like it's going to be harder than the first quarter. Investors kind of throw up their hands at what do I do? You don't want to miss out on the rest of a rally. So what I would say for the rest of this year, though, probably a little bit of Goldilocks. I would maybe caveat that in the third and fourth quarter if the Fed has to come back to the table.
On that note, Weiss, if you say, okay, by virtue of the jobs report today, lack of inflation only underscores this story that the U.S. is the best, period. End of story. The risks that are out there, they're coming from elsewhere. Brexit, elsewhere in the economies of Europe, China, and other parts of Asia, perhaps.
Chinese stocks are up 20% this year.
Yeah, I get it. But that's because they've been stimulating the economy.
All right, so have we. So have we. We did the second biggest tax cut ever.
What's a bigger risk? Our economy or China's?
I'll tell you after it happens. The reality is there will be an. Well, okay, I'll make something up. Look, there are huge risks out there, but there always have been, and sometimes we choose to react to them when it looks like one of them is about to manifest itself, and sometimes we ignore them. We're in a moment right now where sentiment is very good. For whatever the reason might be, the stuff about China and how much debt they've taken on and are they stimulating too much, it's just not impacting asset prices here. It's not even impacting asset prices there. And as a matter of fact, MSCI just made the Chinese component of their EM indexes absolutely massive relative to what it was 3 years ago. So we have decided as an investor class not to obsess over the China risk. Will that come home to roost one day? I'm sure it will. It has before.
So here's
it's not
the story.
It's not a game ender when it happens.
Right. So thanks. So here's the story. Okay, you can't just invest in the market and be ignorant of all risks. I'm not saying you are, but your question.
I am a little.
There are risks out there. It's not all about looking backward and looking at technicals and saying, okay, now we're above the 200-day moving average, because every technician comes out and says, if we break this, then I'm selling.
Is that the majority of the risks are not here at home. It doesn't feel like it.
And I agree with that. The economic risks aren't here right now. We will go into, declining earnings in the first quarter as the reports continue to come out. We all know that. The question is, will they be worse than what's anticipated, or will they not be as bad? And what will the guidance be? If you get the Chinese deal, you will see analysts increase their estimates for the companies that are impacted by it. But here's how I look at it. In Mike Wilson's note today, I agree with his numbers.
Okay, I was going to bring it up. In fact, that's why I'm holding it in my hand right now. We believe this will mark the beginning of an earnings recession, 2 or more quarters of flat or negative earnings growth.
Right, and I don't know
if that's ignoring that. He says not a good entry point for stocks.
Well, and that's not the point I'm looking at. We're not stimulating massively in the U.S., right? We're still holding our head where we were when we tightened, and the message is in December. The only thing that's changed is that we're cutting back in terms of how we're going to take care of the balance sheet. But here's my point. The multiple has expanded. While earnings have gone down, the valuation of the market, just simple math, has increased.
Exactly.
So I don't know how much higher we can go at the end of the cycle.
Are we too expensive?
I mean, we're not seeing indications of being overbought at this level. However, I do think what's interesting is over the last 5 days or so, you've even seen it strengthen an area like financials, which there should really be no reason for financial stocks to be strong in this environment.
Well,
with
they're
the
just
Fed.
tracking rates. Rates backed up a little bit, so banks moved with them.
Right.
If rates were to go down again, you bet your bottom dollar that banks would go down as well, wouldn't they?
But the reality is, and I have to argue with you a little bit, we are actually still very stimulative here in the United States.
That's right.
We're less stimulative than we were 2 years ago. But if you look at the backdrop from a historical perspective, we're very stimulative here. We're very stimulative outside of the United States. And the slowing that's occurred in Europe and in China has been on the back of an accommodative posture. So I just don't know how long this can persist.
My point is not that we're not stimulative here. We are. But it hits a point of diminishing returns.
Not enough for some.
As we're seeing by the fact that earnings aren't continuing to explode, the fact that earnings are forecast to be down about 4%. So at some point you say, we've had these historically low rates for years now, for a decade. How much more demand can it drive? How much more demand to risk assets can it drive? That's my point.
I think that's
not that
a good
real
point.
Rates, when you put inflation there, aren't at zero.
Dubravko wants to get in. Go ahead.
No, just on the valuation side, I would just add that a lot of it is also relative, equities versus bonds. One of the biggest narratives that was being put against equities last year was rates are moving higher. That's capping the multiple. Rates just collapsed a lot, so I'm just saying that's going to provide
So where could the multiple go then is the question?
17.5.